An electric car can look like it is winning the future, even as the profit meter underneath it drains away. BYD manufactures electric vehicles with relentless efficiency. The company controls its own battery technology, operates massive, vertically integrated factories, and pushes its delivery counter higher month after month. When internal combustion engines began losing ground, the investment assumption was simple. The manufacturer producing the largest volume of electric vehicles would automatically capture the market. The showroom tells a story of total victory. But the income statement reveals how brutal the economics of the EV transition become when rapid growth turns into a grinding price war. In 2025, BYD reported its first annual profit decline in 4 years. Net profit fell 19% to 32.6 billion yuan, while revenue grew at its weakest pace in 6 years. That downward trajectory accelerated sharply in the first quarter of 2026, when net profit plummeted by more than 55% compared to the previous year. Manufacturing logic dictates that building more units spreads out fixed costs, reducing the price per vehicle and protecting margins. Scale is supposed to be the ultimate defense, but expansion destroys value if the returns on the capital required to grow keep shrinking. The critical question for investors is no longer how many cars a company sells, but what it had to sacrifice to sell them. When companies fight for a shrinking pool of buyers, they slash prices to maintain demand, keeping top-line revenue large and solid. But beneath that, gross margin is compressed. Even as the company moves more volume, the actual profit contributed by each vehicle shrinks. To prevent buyers from defecting to nearly identical rivals, manufacturers absorb costs they used to pass on. They throw in better warranties or integrate expensive upgrades, like ultra-fast charging capabilities, onto baseline models without raising the sticker price. A car company carries heavy fixed costs for tooling, research, and logistics. When demand slows and product mix shifts downward, the operating leverage that once amplified profits begins amplifying financial pressure. If an entire industry uses price cuts to chase volume, the financial benefits of massive scale bypass the shareholder entirely, landing straight in the pockets of the consumer. BYD is heavily exposed to the budget segment. Cars under 150,000 yuan accounted for over 61% of domestic sales in November of that year. Buyers in this demographic are highly sensitive to monthly payments and visible value. When the government scales back trade-in subsidies for entry-level EVs, this tier of the market experiences the most aggressive price cuts. A lower sticker price travels backward through the company's financial system. Regulators have even pressured automakers to make timely payments to suppliers, who are battered by the margin squeeze. This strain appears in the balance sheet as negative working capital. BYD reported a working capital deficit for daily operations of 97 billion yuan, illustrating how a showroom discount affects cash timing across the entire supply chain. Dominating the affordable EV market grants massive volume. It also forces the company to operate in a hyper-competitive space, where margin erosion is a constant threat. There is a strategic counterargument. A company with deep resources might intentionally absorb lower profits to weaponize its cost advantage, starving out weaker competitors to force industry consolidation. To offset domestic weakness, BYD accelerated its push into international markets. By May 2026, overseas shipments surged over 80%, moving thousands of vehicles out. Exporting introduces immediate friction. Navigating foreign markets means absorbing shipping fees, complex logistics, localized production costs, and political resistance in the form of new tariffs. Selling more cars abroad does not automatically repair compressed margins. It trades a domestic pricing problem for a complex global capital allocation problem. The Chinese electric vehicle market has matured. Early adoption rewarded speed and capacity, but the current phase demands pricing discipline and balance sheet endurance. Market share tells you who is winning customers, but profit margin tells you who is keeping value. These two metrics look similar in delivery reports, but vastly different on an income statement. Because vehicles are physical assets, software economics do not apply. Every unit must be built, financed, shipped, and serviced, meaning a single price cut fractures returns across the entire operational network. Gaining volume by accepting lower profitability creates a resilient operation, but only a superior cost structure and pricing power create a durable corporate advantage. The ultimate metric of success in auto manufacturing is the economic spread. It is the gap between what a customer is willing to pay and what the entire system costs to deliver and maintain that vehicle. BYD has proven it can dominate market volume. Its unresolved test is whether it can convert that global scale back into reliable, long-term profitability. In an industrial price war, victory is rarely claimed by the company that simply sells the most cars. It is claimed by the company that gives away the least economics while doing it.